Hello everyone, welcome to our course on tokenomics for beginners, or Tokenomics 101 if you will. In this course we will be introducing the fundamental concepts in this area. So if you are interested in tokens, digital tokens, hopefully this will serve as a useful basis, and then you can improve yourself further by watching more advanced material. So we will begin with the very basics. We will start with a definition of tokenomics. We will also talk about two key innovations brought by cryptocurrencies or digital tokens in general, which are decentralization and tokenization. From there, we will move on to the demand and supply for crypto assets. We will delve deep here. We'll talk about initial coin offerings, inflationary versus deflationary models, and different types of coin supply. And in the final part, we will be touching upon the investment risks involved in crypto markets. If you look at video descriptions, we've got thumbnails for these sections. So if you want to jump ahead to a particular part of the video, feel free to do that. So let's get started with the basics. So let's begin with giving a basic definition or a fundamental definition of tokenomics. Essentially, tokenomics is the economics of token markets. So it's an abbreviation. Token economics has been sort of abbreviated into tokenomics. And in particular, tokenomics concerns itself with the price formation in crypto markets, right? So when we talk about stock markets, it's all about how prices for stocks are defined within a stock market. And tokenomics aims to understand how prices of cryptocurrencies or other digital tokens and how their prices are formed in market equilibrium. And it's also related, of course, to the creation of these tokens, how they are distributed to investors or traders, and also the general governance matters involved around that. Okay, so after this basic definition, let me talk briefly about two key innovations that piqued interest in this area. The first one is really decentralization, and of course Bitcoin was the pioneer here, which brought about the blockchain technology. So what is blockchain technology? It essentially offers a peer-to-peer network that is secure, that facilitates transactions. So why is that important? Because it reduces, or in fact almost eliminates, reliance on intermediaries such as banks, right? So typically when two parties transact, often they will find it beneficial to do that through an intermediary such as a bank for various reasons. But this creates, for example, additional costs, right? So the intermediary won't do that for free. They will charge for their service. And on top of that, you will also be sharing data with this intermediary, right? So the blockchain technology sort of gets rid of these requirements by creating a transparent network where transactions can be verified without involving banks or other intermediaries. So how does it do that? Essentially, you can think of this blockchain as a massive ledger of transactions that is publicly available. So each transaction that occurs in the blockchain can be viewed for all the parties, and that there's full transparency. And this is managed by the additions of blocks to this chain, and each block has what's called a hash, which you can think of as essentially like an ID number. And each block also involves proof of work. The mining of these blocks involve proof of work, which means that essentially you are using computing power to verify transactions, and it generates a consensus mechanism. So that's what we mean by proof of work, which verifies the whether a transaction is genuine or not. And the second key innovation in this area is tokenization. So Bitcoin was the first popular cryptocurrency, but since then, there have been lots of them around, and the key turning point was the introduction of Ethereum, and with that we started seeing smart contracts all over the place. And what these smart contracts are, that they involve very complex transactions. So it's not just, for example, changing money changing hands with two parties, but this could involve the transfer being contingent on a certain list of conditions being met, right? So then the smart contracts will verify whether all the conditions are met, and only if that's the case, the transaction will occur. And again, this will happen without reliance on intermediaries such as banks. And with these innovations, a new type of crypto tokens came to existence, which are called non-fungible tokens, as opposed to, for example, fungible tokens. So you can think of Bitcoin as a fungible token because each Bitcoin is the same, right? So it's not that you can say, oh, I like this Bitcoin more than this one. It doesn't work like that. They are exactly the same, so they are completely interchangeable. And this is the same for fiat money, for example. So if you've got dollars, it doesn't matter. You hold $1 note and compare to another dollar note, so long as the denominations are the same. Whereas non-fungible tokens are quite different, so they are actually proof of ownership of unique assets, right? So these tokens are not really interchangeable because each of them have different characteristics, and the technology allows the proof of ownership to be verified in a transparent manner. So this has become very popular, for example, in the area of arts, right? Okay, so after talking about these key innovations and the basic definition, let's now delve deeper into demand and supply for crypto assets. So this is where the heart of tokenomics lies, right? So to understand how the prices are determined. So we will begin by discussing initial coin offerings. There is a nice analog of this in equity markets, which are initial public offerings. So initial public offerings occur when a company issues shares to the public for the first time, right? So many companies have done that as they grow. You can think of Facebook, Google, Visa, and so on. So all of these companies at some point went public and sold their shares to the public, and now those shares are traded on stock exchanges. And the same occurs for cryptocurrencies or digital tokens in general as well. So an initial coin offering is essentially the first time those coins are sold to the public investors. And there are several interesting features to note here, and they are important as well in terms of their impact on the prices of these coins. One of them is, for example, called pre-mining. So what happens is that if there is pre-mining involved, essentially the creators of the currency will be able to mine coins prior to the ICO. So then they would essentially build up a certain supply of coins for themselves. And this would essentially be a reward for them and other early investors. This is a bit like in the IPO context, it's a bit like the existing shares of the entrepreneur and venture capitalists and so on. So there's a similar logic there. And sometimes in IPOs, you observe that you issue both primary shares, which are new shares created during the IPO, as well, and also secondary shares, which are existing shares sold by the existing owners, such as the entrepreneurs and venture capitalists. So pre-mining has a similar purpose. And there is another concept called fair launch. So this is different in the sense that in this case, if an ICO is a fair launch, then the tokens or the coins are sold without any pre-mining. And of course, this is good for the investor because then there's no sort of existing supply that is owned by the early investors and founders. So this is how the coins coins start trading and go into circulation. And there are two types of mechanism in terms of the supply of the coins. One is called an inflationary model, and the other one is called a deflationary model. So let's begin with the inflationary model. I think the names are quite suggestive here. So in an inflationary model, so the supply of the coin grows over time because new coins are issued. So there's continuous mining. So as miners create the blocks and they create these coins, they are distributed to the market and the supply grows. And typically there will be no limit on the maximum supply in this case. And this is quite similar in concept to fiat money. If you think of US dollars, for example, the supply of US dollars slowly increase over time as Federal Reserve prints more money. And of course, you can't do that to very quickly and in large volume because that will create inflation, right? So that's where the critical balance is, and the same applies to the cryptocurrencies as well. So if suddenly you sort of create lots of coins, that will definitely have an impact on the value of those coins. But you can also have deflationary models, and this is actually the mirror image. So in this case, you start with typically a maximum supply of the coin, and over time you reduce the supply through token buybacks, and then you can actually destroy those tokens. And of course, as the supply of the tokens go down, their value is expected to grow, right? Because they become more scarce over time. And let's talk a little more about terminology here, because there are different terms used in practice. So it's important to understand the differences. So we should be able to distinguish between circulating, total, and maximum supply. And to do that, maybe one more term is useful here, which is called halving or halvening. So for example, if you think about the Bitcoin, of course, people who mine Bitcoin are rewarded for their effort, but their reward actually goes down over time. And there's a specific figure for that. So their reward goes down by half for every 200,000 blocks mined in this case. So that actually means that the increase in the supply slows over time and results in a sort of a ceiling, which is the maximum supply. So for Bitcoin, this is 21 million. So this means that there won't be more than 21 million Bitcoin in the future, right? And that will, of course, affect the price because, the supply continues to increase at the moment, but it will hit the ceiling at some point in the future, okay? And Bitcoin is already quite valuable, so typically you trade fractions of a Bitcoin because of that, right? But there are some other related concepts as well. So one is, for example, circulating supply. So this is the number of coins that are currently in circulation, but that shouldn't be confused with total supply, which is the amount created so far, but some of the total supply may not be in circulation. Again, this might have implications for the price of that coin. All right, so we've made good progress, and now we've come to our last part of this course, where we'll be touching upon the investment risks involved in cryptocurrencies. There are quite a few of them, and I would like to give sort of a preview here, really, just for you to sort of understand the basics. The first thing the potential investors need to be aware of is that cryptocurrencies are highly volatile assets, right? So it's not like, for example, fixed income instruments like government bonds, where the prices change slowly over time. So you can have quite big swings in the values of these cryptocurrencies, especially those lesser known ones. And if you want to invest in these assets, you have to be comfortable with riding big waves in the value of your portfolio, right? If your portfolio is concentrated in this sort of assets. Another big issue here is price bubbles, because this is still a relatively new market, right? So there are lots of investors who would exhibit what we call herding behavior, and this could result in prices sort of getting detached from fundamentals and creating bubbles, which eventually burst, right? So it's great if you sort of manage to sell before the burst of the bubble, that you can make a good profit. But if you can't catch that moment, that could be quite disastrous for the value of your portfolio, right? So that this happens, of course, or this is not expected to happen, let's say, with more liquid assets or more mature asset classes, but this is a bigger risk in the case of cryptocurrencies. And the third area that's to be mentioned here is related to initial coin offerings. In the past, there have been quite a few scams in this area. So, of course, many people say, okay, I'll go, because they see the opportunity to make money, I'll go ahead and launch my own currency. So as an investor, you really have to be careful about what you are buying into. And one issue here is that these markets in general are either not regulated at all, or maybe regulated in a quite light-handed manner. So that means that the claims made by the issuers can be misleading. They might get away with it because of the lack of regulation. So you have to be very careful before making your investments, and do your due diligence and be relatively comfortable to invest in a particular currency. And the final thing I would like to mention here is the other security risks involved. There have been a number of cryptocurrency exchange hacks. There have been issues with the certain exchanges in terms of their governance and so on. A big example here is the collapse of Mt. Gox in 2014, which was one of the most significant exchanges at the time. And this led to massive losses for lots of investors who deposited their cryptocurrencies in that exchange. So there are lots of risks which sort of should make you aware of what you are getting into. So you need to be really comfortable and do your research and due diligence well before committing your money into this area. All right, I think that's all I wanted to cover in this video. I hope you found it valuable as an introduction, and look forward to seeing you in another video tutorial. Bye for now.